Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for ChartsandMarkets.com. He's speaking to us from Vancouver. Welcome back to the show, Bob.
Yeah, hey, Jim. It must be Friday because here we are chatting on the phone and sending it out to our listeners out there in space, let's call it that.
Yes, cyberspace. And Vancouver looks like it's going to have a very rare sunny weekend for this time of year.
Yep, it's sunning right here now, and it's very pleasant.
And the fog is just lifting off the Fraser River where I live.
Yeah. Oh, I had a couple of days of fog here where I'm on the 17th floor, and I could not see the ground. Yeah,
I couldn't see across the street last night.
Yeah.
Then I opened the curtains. Now, I'm saying, all right, boy, it's foggy. I can't see across. The curtains are closed. Anyway, Bob, inflation is not the temporary thing the Fed said it would be. And I guess, Bob, this isn't the first time the Fed has been wrong. In the U.S., it's running at over 7%, a 40-year high.
Yeah.
What happens to the investment markets when we start having consistent 7% or more percent inflation a year?
Well, it's a huge distortion, and it's absolute insanity because the whole community of policymakers, including central bankers, think that if they're not there, hands-on, fiddling with money supply or fiddling with interest rates, the economy's going to do something bad. But all they are is along for the ride, and you know, the big high for inflation was through the 1970s, and then in 1980 or 81, it got up to 14%. The U.S. long Treasury bond got up to about 15% yield, and in Canada, the long-dated government bond got to 19%. And as you said, your CSBs or
Canada Savings Bonds
we got to 21 or something like that. So.
Yeah.
Now, that was a secular move in inflation made worse by the government. Well, actually, it starts in 1945, which was the secular low in interest rates. Let's say 2.5% for the long bond. And then after the war, there was a huge debt burden, and any politician could understand if rates went from 2.5% to 3%, the cost of servicing that debt would increase. So then they came up with the idea that the Fed would buy bonds out of the market, hoping, I guess, to keep it from rising above 3%. And they kept that up until the early 60s when it got to 5%. And then and that was when the popular dance craze, the twist, came along. So then they came up with an even more aggressive policy of buying bonds out of the market that they called Operation Twist. And keep in mind that this was to keep interest rates from going above 3%, and they really applied it when it was 5%. So what was happening is they were buying so many bonds out of the market that the credit issuance was depreciating the purchasing power of the U.S. dollar, and you're getting the inflation premium cranked into the long bond, and it went up, as I said, to a huge yield. To give you an idea, Jim, when England was the senior economy, in London the financial center, and sterling was the senior currency, in 300 years prior to that, the highest yield in a panic was 6.5%. And these guys, in their efforts to put yields down, managed to get them up to 14 or 15%. So you got to understand that these policymakers truly are crazy. So here we are. And then we go into a period where you have a secular decline. Well, first of all, there was the secular rise in interest rate. There was nothing they could do about it. And then after the commodities blew out in 1980, you then have had a secular decline in interest rates that has been part of what follows every great period of inflation in the past, which is a financial bubble where stocks and bonds go up. So we can say, actually, the inflation has been in stocks and bonds. So here, there's another comparison to make, Jim, and the global commodity boom peaked in 1920, associated with wars as usual. And the rate of U.S. inflation annualized got up to 24% on that one. Then in 21, all the commodity prices crashed, and the rate of inflation went to minus 16. So the Federal Reserve was very aware of deflation. So through the 1920s, they were worried about inflation wasn't enough. So they kept injecting credit into the markets, not understanding that it was a time for inflation in financial assets. Now, that financial bubble would have happened anyways, but the Fed just added to the party. And then when that bubble was over and peaked in 1929, and then you went into a typical post-bubble contraction, there was nothing the Fed could do to keep the party going. So you then had deflation in most asset prices. So here we go. Let's scroll forward. And until the last year and a half, the Fed have been worried about not enough inflation. They said it had to be kept at 2% or higher. So they were easy money during what has turned out to be the greatest financial bubble in history, where bond prices and stock prices have been inflated hugely. And here we are. And then also with these booms like 1929 or now, as you get the final frenzy of speculation, it's associated with a business recovery and an increase in price for commodities. So here we are now, this action, and of course part of it includes the huge crash in many prices with the COVID lockdown. So you're comparing that. So you're now up to a 7.5% rate of inflation, which is very uncomfortable for everyone. But this could be peaking sometime very soon, because our work on the commodities, the CRB index, it's beginning to look very much like the cyclical peak in 2008. Very similar, Jim. So the big story about inflation, I mean, it's happening now, but it's likely in the market. And I'm still saying that in a post-bubble contraction, most everything deflates in price. So that's what is facing us. So, but I just wanted to make sure to review that the Fed for the most of the last decade was doing exactly what it did during the 1920s leading up to that bubble and catastrophe. So for me, an old historian, this is fascinating to watch this whole mania develop. And the Fed is probably scared out of its mind, because they know if they ostensibly tighten, and one Fed spokesman yesterday said something about that, and you had a huge rise in short rates. Now, at the same time, the consumer sentiment figures for Michigan came out and sharply went down. So the other thing about business cycle and stock market cycle is that in a normal world, you get a bull market for stocks, and the S&P goes up and it reaches a high and then rolls over and starts a bear market. But the economy keeps going up typically for 10 to 12 months after that, such that the economists, they build an item called leading indicators, and the S&P is included in leading indicators. But the problem is that when the financial mania has become so big relative to the size of the economy that when the financial markets fail, the economy heads south with it right away. So we're watching this very closely, and that consumer confidence figure was interesting. So what we see, Jim, as the key things, deflated price of copper, deflated price of gold, real long interest rates have been doing what they do at going into the climax of a great bubble. And for the last couple of months, you can say that these key items have sort of stalled out. So the trend that you get with a bubble is no longer, but it hasn't reversed yet. That's going to be interesting when it does. So anyways, Jim, it's so fascinating out there, I can't believe it.
We'll have more with Bob Hoye right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Some of the headlines that you picked up today for us to examine. China taking on risky bubble deflation experiment. What's the experiment apart from locking everybody up in their homes?
Well, they're thinking that the bubble became too precarious, and this is way after the fact. And I think the Communist Party and the Communist Central Bank all want to look like they're in charge of things. So the Chinese stock market stopped going up, and there's been huge major defaults. So they're then posing like they're looking after it. So they're talking about bringing in items to cool the boom when probably it's over. And actually, it was only recently, Jim, when I read a paper about the policy of the Federal Reserve in 1929. And at the end of 28 and into early 1929, some on at the Fed were concerned about the rampant speculation, and everybody in those days knew that once it gets too crazy, and inevitably get a hit. So there was a little group within the Fed that was wanting to raise rates and kind of tighten things, but they couldn't get the committee to agree until August of 1929, when they then raised the Fed discount rate from 5 to 6%. Now, a New York Times article with that reviewed that what the Fed was trying to do was to tighten money to Wall Street because of the speculators. At the same time, it was intended to ease money to Main Street, where businesses, you didn't want to choke them out. But the irony, Jim, is that the T-bill rate went up to 5% in June, and then it started down. And when the T-bill rate starts down, that's a sign that the most exciting part of the boom is probably concluding or over or whatever. And then that was the case. So here you had the Fed raising its administered rate when the T-bill rate was coming down anyways. And then in October, they then took away that last increase and started cutting. And then eventually, the 3-month bill rate got down to something like 0.08%, or effectively zero. And the Fed's discount rate was down to effectively zero, which is what you get in a post-bubble contraction. So it is amazing that the central bankers seem to be well informed about all the theories, but they've never taken the time to look at the theories relative to reality, so they haven't got a clue what's going on. Their models do not work. Like, for example, before 1913, when the Fed Act was passed, the establishment knew that if you had you were in a boom, and if you had a financial crisis, it would lead to a recession. So they came up with the concept that the Fed would be the lender of last resort. So if some bank or company got into difficulty, they would then lend money to it, and that would be fixed. So this would prevent financial crises. And in preventing financial crises, you'd prevent recessions. That's a great theory. It's very attractive. Hey, but since the Fed opened its doors for business in January 1914, there have been 18 cyclical recessions. If you got 3, you know that the system's not working. And now you're out to 18, and the system doesn't work, and they're using the same old tools. And I think the central bankers are about to get a stern lesson in how financial markets really work. So, yep, fascinating stuff.
A question from James for you, Bob. Do they really have to raise interest rates to bring inflation under control, or are high prices the cure for high prices?
Oh, this is what they do. They, in any boom, short-dated market rates of interest, such as T-bills, go up. And I've documented it back to, and then with the Bank of England back to the last half of the 1800s. And the pattern is that in a boom, market rates of interest turn or go up with the boom, and then they turn down with the contraction. And the Fed, and then the Bank of England was the senior central bank, they follow the market action. So all the talk about raising rates is that the T-bill rate is going up as this boom gets intense, and then the disaster will be when the rates come down. But then you see the Federal Reserve has to pose as controlling things. So it then is talking about raising rates mainly because the T-bill rate's going up anyway. So it's very elusive cause and effect on policy and financial markets and stuff like that. So it's going to be fascinating to watch this one work out.
Another headline that caught your attention: Democrats have a choice, either have cheap gas or radical climate policies.
Yeah, I like that headline. That was well crafted, and that is starkly the choice. Now, when the first thing that Biden did upon forming his administration was to do whatever he could to cut production of oil and gas, and then also with pipelines to hinder the transportation of oil and gas. And we wrote at the time, I think he uttered that in December 20 when he won. And so we just said, hey, oil and gas prices up. There's no way they can't, they would go up. And now they're kind of getting a little overdone on crude, but it can run a bit yet. So, but what it is that the political side of the economy has gained massive control. So instead of making economic decisions amongst millions of individuals all making economic decisions, you have what we call the decision from one trading desk, and if they make a blunder, it's huge. So they've got this mania that carbon dioxide somehow affects the climate, but it doesn't. And they then they find that oil and gas and petroleum and gasoline and all that sort of stuff are evil, and they really are intent to shut it all down, just as the federal government in Ottawa is intent to shut it all down. So what's the result? High prices. And then people complain about high prices for gasoline. So then Biden goes and pleads with the OPEC or with the Russians to increase production. But is he going to allow increased production in the U.S.? Of course not. So they're utterly mad. So the choice is, it's high prices for energy or or being practical. And the theories about global warming and climate change and that are all intended. They select the theories that add to the power and wealth of the state. It's just like Keynesian economics. There's a number of economic theories out there, but the reason why Keynes theories became dominant is because it is a vehicle for increasing the power and wealth of the state. So, again, they're doing the same thing with energy prices and the same thing with COVID, that it's been a great item for increasing the wealth and power of the state. So, but I think it's all coming to a head. If you get this financial mania here completing and rolling over, you'll find that people's attitudes are going to change quite quickly with it. And matter of fact, the Freedom Convoy in Canada is a wonderful protest by ordinary people.
Well, Bob, the Earth goes through natural climate change, about 100,000 years of ice age and 10,000 years of warmth. Yep. And we're lucky to be in the middle of that 10,000 years of warmth. Just to make, because where Vancouver was under a mile of ice 10,000 years ago. Yep,
the last ice age at its maximum, say 15,000 years ago, a lot of the ice field in Canada side was maybe 2 kilometers thick, and then it was moving south because ice actually does flow, where it then began to melt where Chicago is now, and but there it has to do with solar mechanics and the activity of the sun and all that sort of stuff, but the huge increase in solar activity that assisted global warming since coming out of the 1800s, that's changed. They were into a quieter solar cycle, and which will eventually have a cooling influence. So, but I note that, for example, on the UAH temperature graph for the satellite one, which is the most honest one out there, that the anomaly in 2016 was plus 0.7 of a degree Celsius, and now the post for January, I guess it was essentially zero, like no change. So what's happening is all the global warming stuff, this chart is now, maybe it's a 30-year chart, but the last 6 or 7 years now, it's a flattening trend of the temperature anomaly. So, yeah, but then again, that was another example of ambitious government using a concept for fear to control people. And, I know a good one, Jim, we can mention, is that in the 1500s was a major cooling trend, and in Europe there was, cooling, rainfalls, and many crop failures. And it was quite distressful, particularly there would be localized famines. But at that time, people really believed that witches caused bad weather. So you had highly educated magistrates in Northern Europe putting on trial witches and charging them, convicting them, and executing them for causing bad weather. Whereas nowadays it's much more democratic because everybody, men, women, and children, are now causing the bad weather. So, I mean, it is really, Jim, it is that foolish.
Well, also things like solar activity and the Earth's orbit, because for 100,000 years we wander a little further out into space, and the planet cools off because it's further away from the sun. Volcanic activity, and I always wonder, how do carbon taxes control volcano solar activity in the Earth's orbit?
No, the taxes and regulations are to control people. That's what it's all about. And
also China's drive to encourage electric car use. They're building hundreds of coal-fired plants to power those electric cars. They're increasing pollution, not reducing it.
Yeah. Turning to electric cars would create so much environmental disasters you couldn't believe it, because you'd have to increase the mining of copper hugely. You'd have to increase the mining of some of these rare earth metals that are required in various electronics, and then even just looking at the structure of a wind turbine, just look at how much cement and rebar goes into just the footing of those things, and it's huge. And then you would have to have so many so many wind farms that it would be an intrusion upon a large part of the country. And the same thing goes for solar farms and generating electricity from solar cells. And again, the areas involved are huge. I mean, really huge. And then, after dark, guess what? It doesn't work. So the problem in using solar and windmills is that it's a very low density form of electrical generation. And then, which you got, of course, have batteries to back up. Now, again, look at all of the exotic stuff that goes into batteries. And then you can build a huge battery field, and it might only supply enough for a day's needs when the wind drops or the sun is obscured by clouds. So, and yet these fools continue to push it when it is totally impractical. So I think this is going to be part of the popular uprisings where the public kind of starts a new bull market in common sense and looks at all of the nonsense in central banking and then in using COVID as a fear item and using bad weather as a fear item to control people. And once they realize that all of these highly promoted issues are done just solely to control people, it's going to be interesting.
Headline: Global bond rout deepens.
Yeah, with the rise in prices and that CPI inflation up, yeah, long rates have gone up. But this may be, for the long treasury, maybe getting a little overdone. There could be a brief trade on the long side for the bond future, but we'll be watching for that, and our subscribers will be advised when the time comes.
And our final headline: the world's super rich drive super yacht orders up 77%. Have you ordered yours yet, Bob?
Super yacht? Yeah. Oh, some of those things are 300 and 400 feet long and cost hundreds of millions of dollars. And but hey, when you're in the big time, you just got to have one of those. But it's amazing how that surge in orders for the new super yachts. But then, of course, in the South Sea bubble in 1720, there are many people who, of a lower class, suddenly became rich. So what did they do? Went out and bought a coach, team of 4 horses with servants in proper livery outfits and all that sort of stuff. And then once the bubble was over, all those grand outfits were for sale in a part of London where that's where you sold horses and used coaches and whatnot like that. So I think that's going to happen again. Only this time it's going to be super yachts, Ferraris, McLarens and Bugatti Veyrons and Lamborghinis and all that sort of stuff are just going to suddenly be on sale at huge discounts. It'll be fascinating.
Right, and Vancouver is the home to the most super sports cars that you can drive, Lamborghinis and stuff. We have more than L.A. And yeah, there's nothing more disconcerting than some pimple.
Guys who are, I know a guy who has a car dealership, and he is selling these things. And a number of years ago, he said, "Look at the Asian money, and tons of it comes to Vancouver, buys the big house, and then buys 3 supercars. You just have to do it." So
yeah, there's nothing like seeing a 16-year-old kid pull up next to you in a lime green Lamborghini with a new driver sticker on it.
Yes, it's totally insane.
Yeah, 750 horsepower in the hands of somebody who doesn't know how to parallel park yet.
Yeah. Well, the first car I bought was a 1930 Model A Ford Coupe, and it had 40 horsepower. So you learn to drive, and then later I had any number of sports cars, some of them highly modified. But what happened was you started at 18 with your first car, and it was slow. And then as me being a car nut, you get into hotter and hotter cars. And then also I spent a season with novice racing out at Westwood and stuff like that. So you gain some experience, whereas this nowadays, dropping a young kid into a Lamborghini or a McLaren is just absolutely amazing. Now, I saw an article recently on the maintenance of one of these supercars, about $150,000 a year, even if you aren't driving it. There's that much maintenance needs to be done to them. Like, it costs maybe $25,000 to put new belts in it for whatever and that sort of stuff. So the maintenance on them is horrendous, but it's all part of the madness of a great financial bubble.
Well, a friend of mine who owned a Jaguar said, Jim, if you own a Jag, you get to know your mechanic on a first name basis.
Well, I had the Alfa Romeos for decades, and I had three all at once: a 1962 Spider, a 1963 Sprint Coupe, and a 1967 sports sedan. So, yeah, it kept me busy keeping track of all that stuff. And then age and the Italian mechanic retired, and so it was just difficult. So I sold them all. So I regret it, but I sold them all. So.
Well, my favorite line from the TV show 30 Rock was, "One day the Italians will build a reliable motor car." Bob?
Well, going back with Alfa Romeos, Jim, it was that the Marelli electrics were not too reliable. But in the case of the Alfa Romeos, the engine, gearbox, transmission, everything were built so strong you couldn't believe it. So the trick was to keep the electricals happy.
Same thing in my Porsche.
Yeah,
there was always something wrong. $900 for a clutch. They're expensive puppies to keep around the house. Bob, always a thrill chatting with you.
Good stuff, and we look forward to next week, Jim.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He was speaking to us from Vancouver. If you have any questions for Bob, you can send them to info@howstreet.com, and he'll dig into the historical vaults and give you the answers that sometimes are very surprising. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.